When you hand someone a $20 bill, there's this illusion of total privacy
Oh, absolutely.
because it's just a piece of paper
Mhm.
trading hands.
Yeah.
Like, there are no microchips embedded in the cotton, right?
Yeah.
There's no Wi-Fi connection broadcasting the transaction.
No permanent digital record.
Right? It just feels entirely off the grid.
Yeah.
And for a lot of people, there's a deep comfort in that simplicity.
Yeah, it's the ultimate peer-to-peer transaction. Physical cash offers this level of anonymity that is just incredibly rare in our modern financial system.
But the thing is, the exact moment you take a stack of those 20s into a local bank to turn them into something else, say like a cashier's check to buy a used car, that illusion of privacy completely vanishes.
Poof, gone.
Suddenly, without you even realizing it, you're crossing these invisible tripwires. So, welcome to the deep dive. For you, the listener, we know you're always eager to learn how the hidden gears of the world actually turn, and today we are decoding those hidden tripwires.
Yeah, we're looking at an official guidance document from the Financial Crimes Enforcement Network.
Better known as FinCEN, right?
Exactly, FinCEN. And specifically, we're getting into the weeds on the Bank Secrecy Act record-keeping requirements. That's 31 CFR Section 103.29.
Which sounds incredibly dense, I know. But our mission today is to look at how regulators actually track money to prevent money laundering. Because this document, it reveals this fascinating cat-and-mouse game between the regulators, the banks, and people trying to move large amounts of cash.
It really is a masterclass in the friction between, human behavior, corporate efficiency, and strict federal oversight.
Okay, let's unpack this, because before we get into the crazy loopholes, we really need to establish the baseline rule that everyone in this ecosystem is trying to navigate.
Right, you need to know the rule before you try to break it.
Exactly. So, according to the document, the regulation requires financial institutions to verify a customer's identity and retain very specific records when they buy certain monetary instruments.
We're talking about things like bank checks, drafts, cashier's checks, money orders, traveler's checks, that sort of thing.
Right. But, and this is the kicker, this does not apply to every single transaction.
Yeah.
It only applies when these instruments are purchased with currency, meaning physical cash. It amounts between $3,000 and $10,000 inclusive.
Yeah, and we really need to pause and emphasize two specific parameters there. Because, first, the triggering mechanism is physical currency.
Meaning paper money.
Right. The rule is entirely dormant if you walk in and buy, say, a $5,000 cashier's check using money that's already sitting in your checking account.
Oh, interesting.
Yeah, it is specifically activated by physical cash coming in off the street. And second, the underlying logic here is all about the conversion process.
What do you mean by conversion process?
Well, law enforcement agencies, they know that illicit activities generate mountains of untraceable physical paper, right? But you can't easily buy real estate or, fund massive illicit networks with duffel bags of 20s.
It's pretty suspicious if you try.
Exactly. So you have to convert that anonymous paper into a highly trusted, traceable monetary instrument, like a cashier's check.
Ah, I see.
So FinCEN, they want to ensure an identity is firmly attached to that money at the exact moment of conversion.
Okay, so that explains the starting line at $3,000. But why does it magically stop at $10,000? It feels kind of arbitrary to let someone off the hook if they bring in $15,000.
Oh, they are definitely not let off the hook.
No.
No, the ceiling exists at $10,000 because crossing that threshold triggers an entirely different, much more aggressive mechanism. It's called a currency transaction report, or CTR.
Wait, what does that do?
If you deposit or spend more than $10,000 in cash, the bank is legally obligated to file a comprehensive report directly to the federal government, period.
Oh, wow. Okay.
So this specific regulation we're looking at today, it's targeting the middle ground. It's designed to capture transactions that are large enough to be, significant for money laundering, but small enough that they slip just under the radar of that massive $10,000 reporting threshold.
I like to think of this 3,000 to 10,000 window as kind of like a financial speed zone.
Ooh, I like that.
Yeah, imagine you're driving down a highway, right? Under 3,000, you are just cruising by. You're under the limit. No one's paying attention. You remain completely anonymous.
Right.
But the exact second your speedometer hits $3,000, you enter this strictly enforced speed zone. The cameras flash, the sirens blip, and you have to pull over to show your ID and leave a permanent record of exactly who you are and what you're doing.
The speed zone analogy captures that transition perfectly. Because once you enter that zone, the bank's role, It shifts from a mere service provider to a compliance enforcer.
Which banks probably hate.
Oh, from a banking perspective, that shift creates an immense amount of operational friction.
Right, let's look at this from the perspective of the teller for a second. Think about it. Imagine you, the listener, are going to buy that used car off a neighbor, right?
Yeah, a very common scenario.
You negotiated the price down to $4,000. You don't want to carry a giant wad of bills, so you take $4,000 in physical cash from your safe at home, walk into the local branch, and ask for a cashier's check.
And you're thinking it's a 60-second interaction.
Exactly. But because you brought in physical cash, and it is exactly $4,000, you're in the speed zone. The teller has to stop everything.
Yeah, the brakes slam on.
They have to ask for your driver's license, verify it's actually you, log your social security number, record the date, the amount, the serial numbers of the check being issued. I mean, they have to generate a completely separate compliance record.
Which means the line behind you is getting longer.
Right. People are tapping their feet.
Exactly. The teller is bogged down in compliance paperwork rather than, serving the next customer. And if you multiply that friction by thousands of branches and tens of thousands of daily transactions,
That's a lot of lost time.
it costs the banking industry a massive amount of time, money, and operational efficiency.
So if these strict rules are causing all this operational friction and eating into bank profits, it's highly predictable what happens next, right? The banks try to engineer a loophole.
Naturally.
Which brings us to this really fascinating workaround detailed in the source document. Depository institutions, so we're talking banks, credit unions, thrifts, they invented an internal policy specifically designed to bypass the friction of the speed zone.
Yeah, many of these institutions started implementing a strict procedural rule for their deposit account holders.
How did it work?
Well, if a customer walked up to the teller window and wanted to purchase a monetary instrument between $3,000 and $10,000 using physical cash, the bank would simply refuse to process it as a direct cash transaction.
Wait, they'd just say no.
They'd say no to the direct cash purchase. Instead, the teller would require the customer to first deposit that cash directly into their own checking or savings account.
Okay, so the physical cash goes into the checking account. Now it's just digital money.
Right.
It's just pixels on a bank screen. And then the teller writes the cashier's check, drawing from that digital checking balance, and boom, they've successfully bypassed the federal cash rule.
Yep.
Because technically, I mean, the instrument wasn't purchased with physical currency anymore. It was purchased with an electronic debit. That's literally washing the cash through a checking account to dodge the rule.
Well, that is exactly how the banking industry framed the argument. I mean, they approached FinCEN and asked for official clarification. They were like, hey, if we run the transaction this way, where a debit pays for the instrument rather than the cash itself, do we still have to follow the strict record-keeping rules of Section 103.29?
And honestly, the logic seems incredibly solid. They literally changed the physical state of the money.
What's fascinating here is how FinCEN completely dismantles that logic.
Yeah.
They do not buy it.
Not at all. They essentially hand the banks a regulatory nice try. FinCEN issues a ruling stating that, well, while the policy itself is perfectly legal, I mean, a bank is well within its rights to require customers to deposit cash first. The strict record-keeping requirements still absolutely apply to the transaction.
Wait a minute, but the cash is digital now. How do they justify that?
FinCEN employs this principle that focuses on the substance of a transaction rather than its mechanical form.
Okay.
They refuse to look at the deposit and the subsequent debit in isolation. Whether it's the bank's mandatory internal policy forcing the deposit, or even if the customer independently requests to handle it that way, FinCEN views the entire immediate sequence of events as a single continuous action.
Let's walk through example 1 from the text because it paints a perfect picture. Imagine customer X walking into a branch with $4,000 to cash.
The teller says, sorry, policy dictates you must deposit this into your checking account first. So the customer fills out the slip, the physical cash goes into the drawer, and the account balance goes up.
Right.
10 seconds later, the teller prepares a debit ticket to take that exact $4,000 out of the checking account to offset the cashier's check.
And FinCEN is looking at that and saying, we see exactly what you're doing. This is a cash purchase wearing a digital disguise.
Yeah, because in spirit and in practical outcome, it is the exact same transaction.
Exactly. Untraceable paper money came in and a highly traceable instrument went out. FinCEN dictates that despite that little two-step dance, the bank is fully obligated to maintain the compliance records.
So the banks just lost their loophole.
They did. But interestingly, the guidance document includes a rather blunt justification to kind of soften the blow for the banks.
Oh, yeah. What do they say?
FinCEN points out that since the customer is already a deposit account holder, which, is the only way they could deposit the cash in the first place, the bank already has their identity verified and on file from when they opened the account years ago.
That is such a sharp, pragmatic counterargument.
Isn't it?
Yeah. FinCEN is basically saying, hey, stop complaining about the paperwork. You already have a photocopy of their driver's license and their social security number in your database. Linking those existing details to this new transaction shouldn't be overly burdensome.
Right. It shuts down the bank's argument about operational friction immediately. It just forces the burden back onto the financial institution's internal software systems to connect the dots.
Okay, so if a massive institution cannot use a clever policy to circumvent the rule, we have to look at what happens when the individual customer tries to outsmart the system on their own.
And human nature dictates they will try.
Always. And here's where it gets really interesting. Because if a customer realizes that $3,000 is the precise threshold where the government starts demanding identification and keeping permanent records, their most logical reaction is to simply stay under the threshold.
Obviously.
It makes me think of someone trying to avoid judgment at the grocery store. Like, imagine you need to buy an absurd amount of junk food for a massive weekend party, but you don't want the cashier judging your dietary choices.
We've all been there.
Right. So instead of rolling up to the register with 3 overflowing carts at once, you break the order up, you play hide and seek. You make 5 different smaller trips to the store throughout the same day.
A few bags of chips at 9 a.m.
Exactly. Some sodas at noon, the desserts at 3 p.m., all hoping nobody connects the dots and realizes how much you're actually buying.
Well, in the financial compliance world, that behavior is a massive red flag.
Really?
Oh, yeah. The regulators fully anticipated this strategy. According to the guidance document, if a customer makes multiple purchases of monetary instruments on the same business day, and those purchases total between $3,000 and $10,000, the bank is legally required to treat them as one single aggregated purchase.
Wait, really? Even if it's different transactions?
Yep. And this applies whether they buy the same type of instrument or, mix and match a money order in the morning and a traveler's check in the afternoon.
Okay, pushback time. How on earth is a massive bank supposed to actually execute that?
What do you mean?
Like, if I visit a branch at 9 a.m. on my way to work and then swing by a completely different branch across town at 4 p.m., there's no way the tellers connect those dots. How can FinCEN demand a bank magically piece together my daily itinerary?
That's a great point, and it comes down to the critical, legal, and operational definition of knowledge. The guidance text explicitly states that the aggregation rule only applies if the financial institution has knowledge that the multiple purchases occurred.
Oh, so it's not a magical expectation.
No, it is bounded by what the bank can reasonably ascertain.
Okay, let's explore how knowledge actually plays out at the teller window. Let's look at example 2 from the document.
Okay, yeah.
So at 10 a.m., a customer walks into a bank with $2,000 in cash. They go up to a specific teller, teller 1, and buy a money order for $2,000.
And because $2,000 is under the $3,000 tripwire, they don't trigger the record-keeping requirement.
Right. They're safely under the speed limit. The transaction goes through without any friction. But later that same business day, the customer returns to the exact same branch.
Okay.
And they happen to walk up to the exact same teller they saw that morning. This time, they hand over another $2,000 in cash and request a cashier's check.
Boom. At this precise moment, the concept of knowledge is activated.
Because the teller is standing there looking at them thinking, wait, I just sold you a money order 4 hours ago. The human being behind the desk serves as the mechanism of knowledge.
Exactly. Because the teller personally remembers the morning transaction, the bank, as an entire institution, is now deemed to have knowledge.
Wow.
Yeah. The 2 isolated $2,000 transactions are instantly aggregated into a single $4,000 transaction. The $3,000 threshold has been crossed for the business day, and the teller must immediately halt the process, demand identification, and log the compliance record.
But relying on a teller's memory feels incredibly flimsy, right? Like, what if the teller went on their lunch break and the customer walked up to the window right next to them?
Yeah.
The second teller has no idea who this person is. Does the bank still have knowledge?
Well, you have to remember, in the era when this guidance was formulated, a teller's physical memory was a major component.
True.
But as banking technology has evolved, knowledge has shifted from human memory to systemic
Oh,
tracking.
of course, the computers.
Right. If the customer uses their debit card to access their profile before handing over the cash, or if the internal software flags two separate cash transactions tied to the same customer ID on the same day, the computer system provides the knowledge.
Got it.
The bank's software automatically aggregates the totals and literally locks the teller out of completing the second transaction until the compliance data is entered.
But the guidance document goes a step further than just requiring the bank to log the aggregated total, right? I mean, it issues a very stark warning about this specific type of behavior.
It does. It points out that frequent or sequential purchases of monetary instruments are a primary indicator of money laundering.
So it's not just an innocent mistake to them.
Not at all. The document requires financial institutions to implement rigorous procedures to control the risks of what it calls contemporaneous purchases.
Meaning buying stuff at the same time.
Exactly. Breaking up a $4,000 transaction into $2,000 transactions to deliberately avoid a reporting threshold that is a federal crime known as structuring.
Structured.
Right. And if a bank suspects a customer is actively designing their transactions to evade Bank Secrecy Act requirements, the situation escalates dramatically. The bank is required to determine whether the circumstances warrant filing a SAR, a suspicious activity report.
Okay, let's clarify what a SAR actually is, because
Yep.
that is a massive leap.
It's huge.
You go from having your driver's license recorded in a local bank's compliance logbook to having a dedicated intelligence report drafted about your behavior. And that report doesn't just stay at the bank, does it?
No, not at all. A suspicious activity report is transmitted directly to FinCEN's massive database, which is accessible by the FBI, the IRS, and local law enforcement agencies across the country.
That is wild.
It alerts federal investigators that a specific individual is exhibiting financial behavior consistent with criminal activity. It's basically the difference between getting caught in a speed trap and having an active surveillance file opened on you by federal detectives.
So what does this all mean for the life cycle of that data? Let's trace the journey for a second. The bank spots the transaction, they verify your identity, and they create the required record under Section 103.29. Where does that record actually go, and what are the stakes for the financial institution if they, lose it?
Well, if we connect this to the bigger picture, the guidance mandates a strict 5-year financial paper trail,
5 years.
5 full years. Any records required by this specific section must be retained by the financial institution for 5 years. Furthermore, the bank must have systems in place to ensure these records are easily accessible and available upon request to FinCEN or any agency with delegated authority.
5 full years of records for every single $3,000 cash transaction happening at every single bank branch across the entire country.
Yep.
The sheer volume of that data is staggering.
Yeah.
How do they even manage that logistically? I mean, are we talking about some massive hidden warehouse in the desert just filled to the ceiling with dusty boxes of deposit slips and teller logs?
Well, we look back a few decades, it was quite literally massive warehouses filled with microfilm and pallets of paper boxes. The logistical burden was astronomical. Today, of course, it has transitioned into massive, secure digital server farms and cloud storage managed by the banks.
Right.
But the core concept remains the same, It effectively turns every single local bank branch, no matter how tiny or rural, into an active node in a vast historical data retention network.
So the government essentially outsources its data storage. They don't need to build a central trillion-dollar repository for every daily transaction if they can legally compel every private bank in the country to store the data for them on their own dime.
Exactly. And that data retention is crucial for long-term criminal investigations. Because financial crimes, particularly like major money laundering syndicates or cartel operations, they often take years to unravel.
Oh, sure. They're complicated.
Extremely. If an FBI task force is investigating an illicit network today, and they need to trace how funds were moved through cashier's checks 4 years ago, they need to know the paper trail hasn't been shredded. The 5-year mandate ensures that evidence is sitting there on a server, legally preserved, waiting for a subpoena.
It fundamentally changes how you view a bank.
It really does.
For you listening, the next time you step into a bank lobby to handle a chore, just take a look around. You aren't just standing in a building that holds money in a vault. You're standing inside a highly regulated, active data collection agency operating under incredibly strict federal retention laws.
Yeah.
Every teller interaction, every cash deposit, every instrument purchased. It's a potential data point being fed into a 5-year memory bank.
The bank is legally conscripted to serve as the eyes, the ears, and the memory of the federal government's financial enforcement apparatus. It just highlights how deeply intertwined private commerce and state surveillance really are.
Absolutely. Let's quickly recap what we've unpacked in this document today.
Isn't good.
We started with the baseline tripwire,
Yeah.
right? The regulation that anytime you use physical cash between $3,000 and $10,000 to buy instruments like a cashier's check, the bank must pause the transaction to log your identity. We saw how banks tried to engineer a clever workaround by forcing customers to deposit the cash first, and how FinCEN firmly closed that loophole by declaring that washing cash through a checking account doesn't magically erase the underlying reality of the transaction.
Right. They see right through the deposit trick. And then we also explored the same-day aggregation rule, detailing how banks track multiple smaller transactions to catch individuals attempting to structure their purchases.
The whole grocery store hide-and-seek thing.
Exactly. And finally, we looked at the sheer logistical scale of the 5-year data retention mandate, which ensures investigators can reconstruct financial history years after the fact.
It is a massive, invisible compliance machine operating right beneath the surface of our daily errands.
It is. And as we wrap up, I want to leave you with a final thought to mull over, building directly on the text's warning about suspicious activity reports, because I want you to consider the incredible paradox this entire regulatory framework creates for an ordinary citizen's personal privacy.
Oh, this is the perfect way to look at it. Let's hear it.
Okay, think about this. If you are an informed citizen, and you know that the federal government starts tracking you and logging your identity at exactly $3,000, you might value your privacy enough to alter your behavior.
Makes sense.
You might intentionally decide to only buy $2,999 worth of money orders.
Right.
You aren't hiding drug money, right?
Yeah.
You aren't doing anything illegal whatsoever. You simply do not want your personal name and social security number sitting in a federal compliance database for 5 years.
Which is a totally reasonable desire.
Right. But here is the paradox. Doesn't the very act of legally avoiding the threshold structuring your completely innocent life just to maintain your baseline privacy?
Yeah.
Doesn't that suddenly transform your behavior into the exact suspicious activity the bank is required to report to FinCEN?
That is a brilliant point. The very act of seeking privacy is mathematically indistinguishable from a criminal attempting to hide illicit funds.
Exactly.
By trying to quietly step around the tripwire, you might actually be setting off a much louder, much more aggressive alarm.
It's catch-22.
It really makes you wonder how much privacy actually exists once you walk through those glass doors.
Yeah.
Well, we hope this deep dive gave you a completely new perspective on the invisible regulatory forces shaping the financial world around us. Thank you so much for joining us, and keep questioning how the hidden gears turn. We'll see you next time.